This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 225, and I'm smiling if you're watching on YouTube because Ben just told me a story off mic. Ben, you got to share this story.
Okay. So our neighbors down the street had a trampoline outside. It's probably 16 feet. It's the biggest trampoline I've ever seen. It's massive.
People know where this is going.
And they asked if we wanted it because their kids have aged out of it, and they didn't need it anymore. So they were going to give it away or donate it or whatever. But before they did that, they asked if I would come take it apart if we wanted it and bring it over to our house. So I said sure, brought it over. It sat in our garage for a couple weeks. The kids were asking me about it every day because they knew we had it. And so finally last night I got around to setting it up, but instead of setting it up outside, like the neighbors had, and like I think most people probably have.
Do you think?
we set it up in the living room of our house. So now the living room is mostly a gigantic trampoline.
And what did you do at lunch today?
Yeah, I went when I went downstairs for lunch today. I spent 5 or so minutes bouncing on the trampoline.
How high are your ceilings?
They're high. Our house is the way it's got probably 25-foot ceiling
So
in
it's
the
like
main
a
part
loft
of the
up
house.
top or something.
Yeah, it's a big loft. But there's the loft on one side, but then the kind of main living area is just right up to the high ceiling.
I love it. Completely non-traditional and what makes you happy. I think it's fantastic.
Yeah. So we currently have a climbing wall, a slide, a swing, and an enormous trampoline in our whatever you thought it's the equivalent of a living room, but it doesn't quite conform to what a living room would look like.
So I got a story for you. So, I was at a conference last week in the States, and a bunch of us hopped an Uber to go to a restaurant for dinner. And so we pull up at the restaurant, and there's this great big blue bus in front of the restaurant. It's like, okay, it's a big blue bus. Then you look around as you get out of the Uber, there's all these black SUVs. I haven't told you the story, have I? So these black SUVs, I'm like, okay, something's going on here, but we didn't really think much about it. Then all of a sudden we look like to our right getting out of the Uber, and there is Douglas Emhoff, who is Vice President Kamala Harris's husband, was like right beside us as we got out of the Uber. So that was pretty cool. I've never come anywhere near, a political figure like that, certainly not in the U.S., and lots of people around him, of course, but we got pretty close. A couple of the people in our group actually got selfies with him, which was kind of cool.
Did I ever tell you at the time that I had dinner across from Justin Trudeau?
No.
I never told you about that?
No.
It was a couple of years ago when he was prime minister. Susan and I went for sushi randomly. I guess this was pre-COVID. Yeah, it was definitely pre-COVID. We sat down to have some sushi, and then these like security guard type, Secret Service looking people, I don't know what we call our equivalent in Canada, they come in and sit down. I'm like, what is going on? Like, these people don't look like they're coming to sit down for dinner. And then 5 minutes later, Trudeau walks in. I was like, whoa, that's my political figure close encounter.
It's funny, I met people at this conference, and they said, it's really strange to talk to you at 1x speed, which is pretty funny.
Because they're used to listening to the podcast on 2x or whatever.
Some listen to us at 2x. I don't know. I can't do it.
That's funny.
Yeah.
Your setup looks different.
Oh yeah, behind me, I'm trying to improve my home office now that I moved upstairs to my son's former bedroom. So I got some acoustic paneling up there. Going to fill it all in eventually, but we're getting there.
It looks
slowly.
great.
Yeah.
It looks like you actually have a podcast or something.
Which is always a reaction, right? When we talk to people, often when I talk to advisors that reach out, they say, oh my gosh, it feels like I'm on the podcast.
Yeah. Kind of drives me crazy. I kind of want to have like a non-podcast office so that people don't say that anymore. It's like that's like the equivalent now of when I used to see people in person and they would comment on my height.
Yeah, you don't get that anymore, do you?
No, now I just get the podcast studio comment.
That's interesting. It was always so funny when people meet you. Yeah. I know you hear this all the time, but do you play basketball?
Yeah. So we passed 4 million audio downloads all time. So since we launched the podcast, whenever that was, to now, or yesterday, I guess. We've passed 4 million. What day did we pass? Do you know? Do you remember?
It was one day last week. I think it was last Thursday.
And so that's just audio downloads. And then on the Rational Reminder YouTube channel, we're just about at 1 million total views. I think probably by the end of November, we'll have passed 1 million views.
Mm-hmm.
Kind of cool.
Mm-hmm.
Next week, our guest is, I from the perspective of decision making and success and living a good life and all that stuff, I think he was a really cool person to speak with. So it was Commander Chris Hadfield, who's a Canadian astronaut. He's been to space. He's lived on the International Space Station, and he's got really nice perspectives on success and living a good life and achieving big goals, but not letting them kind of run your life and not being disappointed if you don't achieve them. Really good perspectives.
It was a great interview. So happy we could have him on. This being Financial Literacy Month, the sale is continuing. So spend $30 in the store and get 50% off the Talking Sense cards. And you also get a free pair of socks and a cozy, and that goes all month of November. Your topic today, I think, is super interesting about the tipping point of index funds. So that's what you dive into this week.
Yeah, so I'll talk about this when we go into the topic too, but one of the coolest things about that, I don't know where the idea came from exactly, but you know what? Someone sent me an email. That's what it was. Someone sent me an email saying, can you do a video on inflation and a video on index funds, like breaking the market? Because I guess that's a thing people are talking about again. So I was like, sure. So I worked on this one, but I wrote it and then realized when I was done writing it that all except for one of the papers that I referenced in the video are papers that we've discussed with the author on Rational Reminder. It's kind of cool.
Mm-hmm. That's very cool.
Yeah. We had in one of the segments in today's show, we had Jordan Tarasoff, who is a financial planner on our team at PWL, and he talks about this kind of funny thing that's happened with Canada Pension Plan, CPP in Canada, the government pension scheme. I won't go into the details, but there's typical financial planning advice that makes sense with respect to Canada Pension Plan, and based on a few factors this year being different from typical, the kind of best practices thinking for that have changed. So he gives us some pretty cool insights.
Yeah, we got a lot going on this week's episode. We're also going to try something new, which we have so many great conversations with so many cool guests over the past 4 years, and I find myself often going back and re-listening to past episodes. So I thought as a refresher, what we try to do is a 60-second condensed summary of that interview. So I'm going to take the first crack at it today and see if I can boil down our conversation with Scott Rickens down to 60 seconds. We'll see how that goes. Bit of an experiment. And then also for Financial Literacy Month, instead of doing a traditional book review, we're going to give 5 recommended books that we think will help people improve their financial literacy. These are all easily accessible, affordable, easy reading, and enjoyable books. So we're going to review 5 this week, and then we'll do 5 more in 2 weeks. So that, Ben, anything else to add to the intro?
Nope, all good. Let's go to the episode.
All right, welcome to the main part of episode 225. Ben, take it away.
All right. So as we said in the intro, the main topic today is the index fund tipping point, which is just the concept that too much money is going into index funds and price discovery is going to stop working and the market's going to become inefficient.
This has to be the most popular critique of index funds.
Yeah.
Can't prove it.
I made a video on this and we covered it on the podcast too a while ago because it was everywhere and everyone was worrying about it. I don't know how you'd measure this. Maybe Google Trends or something. I didn't try doing that. But just from the general buzz that I hear about it, this concern is resurfacing. It has resurfaced in the last few months. I don't think it's as prevalent as it was last time we covered the topic, but I thought it was worth addressing. And I've also got a different, I think, angle than than last time. Last time we talked about it, we basically said a few different things, but the big punchline was that even if index funds are a large part of the market, they're responsible for only a tiny amount of the trading. And I think that still shows up in the data that we're going to talk about, but we're covering it from a different angle using different research. So I think it's another interesting perspective. Okay, so I think it's safe to say at this point in time that index funds and index investing more generally are mainstream. I don't think anybody would dispute that, and neither do the data. So at year-end 2021, and this is a fairly recent report that came out from the Investment Company Institute, more of the U.S. stock market was owned by index funds than actively managed funds for the first time as of year-end 2021. So that was a big deal. Now, that doesn't mean more than half of the U.S. market is owned by index funds, because funds only own about 30% of the U.S. market. And we have a chart that we will have showed in the YouTube version of this that shows that, like, funds are this tiny little piece in the bottom, and then the remaining assets are there's this massive 70% that's owned by other institutions and stuff like that. But even looking at other institutions, so not looking at just funds, but looking at institutions more generally, and there's a paper from Ralph Coyne that does this, which is what I reference for this part. But if you look at that bigger institutional pool, assets there have also been shifting toward more passive institutions. So funds, it's a majority at this point that are in index funds. But then also on the institutional side, there's been a big shift. I don't have as clean of a number, like it's 50% or whatever, but there's been a significant shift. The active share of institutions has decreased significantly over the last 40 years. So we'll talk more about that data in a minute. Now, this is important. Like it's a valid concern that there is a tipping point. It's not like, oh, this is stupid, you shouldn't worry about it. It's a valid concern. And we'll talk about a few different angles on that. Index investing as a theoretically optimal investment strategy works in an efficient market. But of course, the concern is if everybody turns passive, then the market can't be efficient. That's the whole Grossman-Stiglitz paradox thing that we've talked about before. And that's what has some people kind of raising the alarm and being concerned right now. In an efficient market, the market portfolio, and we've talked about this with Fama, we talked about John Cochran, we've had lots of interesting conversations about the market portfolio, which the market portfolio is theoretically everything, literally all ownable assets. But as we talked about with Fama, we can kind of proxy it with stock and bond index funds. Theoretically, at least in CAPM theory, that is the optimal portfolio for all investors. In multi-factor asset pricing theory, it's still the optimal portfolio for the average investor. Now that of course makes investing very easy. In the CAPM world, there's a single optimal portfolio for everyone. In the ICAPM world with multi-factor asset pricing, you can at least say whether you're different from average or you can just decide that you want to invest like the average investor. And in that case, index funds are theoretically optimal. All of that makes investing super easy and low cost, which is, I think, why some of the reasons why index investing has gained popularity, because they're super easy to own, super easy to invest through. You can buy 1 or 2 or 3 maybe ETFs and have the market portfolio or a proxy for the market portfolio. Now, that all changes if markets are inefficient. So if we had some measurable way to say, okay, the market's changed now, the market's no longer efficient. In that case, the market portfolio is no longer theoretically optimal as an investment in the theory, and investors should shift from passive to active. So we talked about this with Luboš Pastor. He's got a paper on the size of the active management industry. We talked about this like in an older Rational Reminder episode. So Pastor and Stamba, in that paper, they argued that the active management industry faces decreasing returns to scale. And we talked about this with Burke and Van Binsbergen too. So the ability of fund managers to outperform a passive benchmark declines as the active management industry's size increases. I think that's fairly intuitive. When there's more money chasing opportunities for alpha, prices are impacted and those opportunities become elusive. In their model, and this is the same as Burke and Van Binsbergen, I don't know if it's the same model, but it's the same effect. Negative alpha for the active management industry as a whole is a sign that too much capital has been allocated to active, not that active managers are unskilled. So that's important. But the corollary there is that if the active management industry gets too small, that negative alpha turns positive. And again, that's not necessarily a sign that active managers are skilled. It's a sign that they're being under-allocated to. And investors should shift to active to mop up that alpha.
What about the other argument where if there's too few active managers or fewer active managers, that the ones that are remaining are the most skilled, therefore you have more competition, tougher competition?
Oh, I'll get there. It's coming.
Okay.
It's coming. I think that's the next point I'll make. But you're right. And that's actually that is one of the main points here that I'm going to make in a second. So good observation. Now, the concept though that there is this equilibrium and that the negative alpha means investors are over allocated to active management and should index, cool. But that also there's a potential for alpha to become positive and therefore investors should switch from index to active. That creates uncertainty for index investors. And we talked about this with Lubosh Pastor, and I asked him outright, like, does that mean investors should switch to active? And he said yes. He said, Lubosh, I index now, but I'm waiting for that point where I should switch to active. And it's like, man, that sounds exhausting. Like that's the whole reason I think a lot of people index is that you don't have to do that kind of thing. And like, how do you know? How do you know when the tipping point's been reached? And we kind of got into the weeds on that with Lubosh and discussed like, okay, like then when do you go back to index and how do you know? It was an interesting little conversation there, but and I don't think it's super obvious. And then like, are we already there? I don't think we are. We'll talk more about that. And then of course, when do you switch back to passive if you do switch to active? But all that, just having the existence of those questions that indexing isn't necessarily a perpetual optimal strategy, I think that takes some of the shine or has the potential to take some of the shine off of indexing. Now, the good news that I want to share, at least in my opinion, is that we're nowhere near any concept of an index investing tipping point. If there is a tipping point, and I guess theoretically there must be, but realistically, whether it would ever be reached, I think is not super obvious. I also think that the people talking about this, saying that we are reaching a tipping point, that index funds are going to break the market or whatever, I think they're probably trying to sell you something in most cases, at least from the views that I've heard. Yeah. So I hopefully people think that's good news to hear me say that, but I also want to go through the reasoning. So touching on some of the stuff that you brought up, Cameron, and a few other things, so that people don't just take our word for it. They can understand why this maybe isn't such a concerning thing. So it starts with, of course, a Fallman French paper, Disagreements, Tastes, and Asset Prices, which is a great paper that we've talked about many times, including with Ken French, who was very excited that we asked about it. So they have this paper that shows that if misinformed and uninformed active investors who make prices less efficient by trading switch to market cap indexing, market efficiency actually improves. So that's the comment that you made earlier, Cameron. It gets harder to be an active manager because there's more competition. That's like the relative level of competition as opposed to the absolute level is what matters. So if informed active investors, so the ones that are doing a good job setting prices, the skilled active managers, if they switch to indexing, then in that case, prices do become less efficient. So this is the concern, I guess. If everybody, including the skilled managers, go to indexing, then there is a concern about ongoing market efficiency. But as long as there are some remaining informed active investors, even if there are a small few, as long as they're skilled and they command a lot of wealth, which they would, and we'll talk more about the empirical side of that in a second, as long as there's a few left and they're competing with each other, theoretically prices remain efficient and arguably even more efficient than they were in the case where there were still some unskilled managers. Mm-hmm. So in that paper, they explain that in equilibrium, investors combine what they deem to be the tangency portfolio with risk-free borrowing or lending. It's the CAPM theory, that the market portfolio is the one optimal portfolio. And in this paper, they talk a bit about ICAPM too, but just thinking about it from a CAPM perspective gives you a simple model to walk through the logic. So informed investors in their model choose the true tangency portfolio, which is called portfolio T, while the misinformed investors in aggregate hold a portfolio that they call in the paper portfolio D. So we've got the true tangency portfolio, the truly optimal portfolio that an informed investor would hold, portfolio T, and the misinformed portfolio D. And the value-weighted market is the wealth-weighted aggregate portfolio M they call, which is the combination of both portfolio T and portfolio D, the true tangency portfolio and the misinformed portfolio. So together, of course, they make up the market. Now, in the CAPM, the market portfolio is only the tangency portfolio. So they're the same. Portfolios T and D are the same portfolio if misinformed investors as a group also hold the market portfolio.
Okay.
And they walk out through in the paper a few instances where that would be true. But of course, also if the misinformed investors just go away, then the market portfolio is the tangency portfolio. The tangency portfolio is the portfolio that theoretically all investors want to own. It's the optimal mean variance portfolio, which must be the market if prices are efficient. And we've covered that in a bunch of previous episodes if people want a refresher. It's funny that people listen to our podcast. So back to this topic of the index fund tipping point idea. This idea of informed and misinformed investors and portfolio D, the misinformed portfolio, and portfolio T, the tangency portfolio, is very important because, as I mentioned, if the misinformed investors are the ones that switch to indexing, the market portfolio actually moves closer to being the true tangency portfolio. So you actually want that. You want the bad active managers to leave, and then you have more confidence that the market portfolio is the truly mean variance optimal portfolio. If you've got a bunch of misinformed active managers, there's a pretty good chance the market portfolio is actually sub-optimal.
Isn't that interesting to think about?
Yeah, I know. I love this part. I find it very interesting too. And I don't know. I don't know how I would describe the visual, but my brain has a nice picture of how it works, and the portfolio shifting toward, like, I don't know. I wish I had an actual visual to describe, but it feels right.
A visual of inside your brain.
It feels right when I think about it, that the misinformed investors go away and this portfolio, the market portfolio converges with the true tangency portfolio, and then they overlap, and it's all nice and perfect. And in that case, index investors are owning the truly optimal portfolio. Now, this clearly makes it important to ask that question of who is turning passive. So we know all these dollars are shifting from active to passive. We know that's happening at the fund level and at the institutional level, but who's turning passive? Because if it's the misinformed, then great. That's good news. If it's the informed, that's bad news, and we should maybe be looking toward allocating to some skilled managers. Okay, so, and I guess another piece of that is, if it is what's like what you said earlier, and what I also alluded to, is that if it could be two remaining active managers competing with each other, if they had a huge amount of wealth that they were in control of and were very skilled, and that could be it. If it's just those two active managers, then other than that, the capacity of index investing is huge or infinite. I don't know, as long as those two active managers have enough. I guess we don't know exactly what enough is in that case. Anyway, so on the fund side, there is research from Burke and Van Binsbergen that we did speak with them about, asking that question of where does the capital flow in the active management industry. So they've got their 2015 paper measuring skill in the mutual fund industry. They find empirically that there is evidence of persistently skilled mutual fund managers, and that fund investors are proficient at rewarding skilled managers with flows into their funds. So in their sample, based on their measure of skill, they find that most active funds destroy value, but most of the capital is controlled by skilled managers who are adding value to their funds. Now, if you listen to that episode or our discussion afterwards, you'll remember that that doesn't mean that investors are getting positive net alphas, because that's not how they measure skill. They measure skill with value added, which is gross alpha times the size of the fund. Anyway, so different measure of skill that's not necessarily relevant to the end investor because you can't go and benefit from that. You just get the risk-adjusted returns of the fund in equilibrium. But it is a way to measure skill, and from that measure, they find that capital flows to the skilled managers. And there's other data, I don't think it was in their paper, but just data on persistence in or survivorship, I guess, in funds that don't perform well and don't gather assets. They tend to be the ones that close. So anyway, I think based on their stuff, it's reasonable to say that at least in the mutual fund world, it is the unskilled managers that are leaving, or that assets are flowing away from. On the institutional side, more broadly speaking, and this does include mutual funds, but also a whole bunch of other assets. So Coyen, Richmond, and Yogo have a paper, Which Investors Matter for Equity Valuations and Expected Returns. And they find in their sample of institutional investors that overall active share, which is like how different institutions are from the market portfolio, has declined over the last 40 years. And that decline was mostly due to capital moving from more active institutions to more passive ones.
Right.
Now that so far doesn't tell us anything about whether it's the skilled or the unskilled active institutions the capital's leaving. Their sample does have mutual funds, but also investment advisors, hedge funds, pension funds, life insurance companies, private banking, and brokers. So it's a pretty broad sample. They find that the aggregate active share dropped from 45% in the 1980s to a little over 25% at the end of their sample in 2019. So big drop in active share. And again, it's not perfectly comparable to like 50% of the market, of the fund market is in index funds, but whatever, at least we have a measure to compare. So big drop in active share over that time period. Now they find that the capital going passive, this is the important part, the capital going passive was leaving both informed and uninformed active institutions roughly equally. So they don't find any change in price efficiency using their measure over their sample period. Now, to test how the shift toward passive may have affected asset prices, because this is another part of that whole index investing is bad narrative, they model the counterfactual, and this is, if anybody remembers our episode with Ralph Coyen, they use their demand system asset pricing approach. That's hard to think about. Going back, though, to look at this topic again and prepare this discussion, going back to that episode with Ralph and reading the transcript, it was like, oh, this makes a lot more sense now the second time reading it after a few months taking a break. So if anyone wants to go back to the Coyen transcript, it was easier to grasp the second time around. Okay, so to test how the shift may have affected asset prices, they model the counterfactual where the shift never happened. That's maybe hard to think about, but I'll just keep going and hopefully it makes sense. So they find that the move from active to passive has resulted in a substantial change in valuations, especially among smaller firms. So that means that particularly small firms, which are previously held by active institutions, and if you think about it, active managers basically by definition, to be different from the market, active managers on average are going to overweight small caps relative to the market. So they find that those small firms, which were previously held by active institutions, saw their valuations fall as capital shifted from more active institutions to more passive ones. So valuations decline. Now, while they see the valuation effect, they also find that the informativeness of prices is affected very little. So small companies mostly see their valuations affected as funds flow from active to passive, but the informational content of prices they don't find to be affected in any meaningful way. Now, one thing that I think is important is, and we kind of alluded to this with Ralph in the episode with him, is that this is basically the opposite of the index fund bubble narrative. That which suggests that, you know, the largest stocks in the index are getting their prices pushed up relative to fundamental values. What actually seems to be happening, based on the Coyen paper, is that the assets that were previously held above market weights by active managers, which will tend to be smaller companies, are falling in price as capital flows away from them, but the informational content is not being distorted. So as opposed to price distortion, There's a change in valuations, but the informational content of prices is not really affected. Yeah. But I mean, when you think about it, right, when $1 is added to a market cap weighted Vanguard fund, the flow into the fund proportionally affects all stocks in the market, proportionally, because it's being allocated proportionally.
Yeah.
So there's no cross-sectional impact when funds flow into a total market fund. So if somebody switches to indexing, the securities that were overweight or underweight in the active fund, their valuations will be affected.
It makes sense.
Right.
It's that migration from a non-total market portfolio to a total market portfolio.
Right. And that's where the cross-sectional impact happens on prices, from the money leaving active going into passive, not from the money. The effect isn't on the side of the largest holdings in an index fund having their prices pushed up, because the cross-sectional impact is roughly zero as funds flow into an index fund, because the flow is proportional, because the portfolio is proportional. So they also find in their paper that the most impactful groups of investors per dollar of assets are hedge funds and small active investment advisors. And a huge passive firm like Vanguard, and they look at this in the paper, is not at all influential in setting the cross-section of prices, because they mostly own the market. Now in their paper, I think they're looking at all of Vanguard, not just the indexing business, but even still, the active share of Vanguard is extremely low.
Isn't that fascinating for some company as huge as that?
Yeah, I mean, they're largely business and largely in index, and I don't know, I haven't looked too closely at their active funds, but I don't know if they're like super high conviction, small cap value active. I don't know, but either way, in aggregate, the active share of Vanguard is not super high in the Coin paper. Okay, now the other thing we got from Coin was the inelasticity stuff, markets being inelastic. Funds going index potentially, and this is another thing that I've seen on this index investing is bad stuff. Is that this is the problem. The markets are becoming inelastic, and that's somehow bad for investors. But an inelastic market is not necessarily less efficient, and we talked to Ralph about that too. And the other thing is that it's not clear that the growth of index funds has made markets more inelastic. To say that, we would need to know in aggregate where the assets that went passive came from. If it came from individual households who were previously buying and holding individual stocks forever, never selling, going into index funds, which are periodically reconstituted, would actually make markets more elastic in that case. Anyway, so based on the Coin, Richmond, and Yogo stuff, the shift toward passive seems to have affected valuations, particularly among smaller firms, downward, but it's not affected the efficiency of market pricing. And maybe it affects market inelasticity or elasticity, but even that we don't know for sure. And then the last one that I want to touch on is Coles, Heath, and Ringenberg. They find in their paper on index investing that passive investing does not undermine price efficiency. So they use a Grossman-Stiglitz framework. They predict that the rise in indexing will have no effect on price efficiency. Their intuition for that prediction is that in equilibrium, a decrease in the cost of index investing leads to more index investors and less active investors. But because investors will always choose to gather information when it's profitable to do so, the proportion of investors willing to pay an additional cost to uncover new information adjusts such that the returns to active remain unchanged even as indexing increases. So in that model, price efficiency remains unchanged. And they test this to test their predictions. They examine the effects of index investing on information production and price efficiency using variation in Russell Index membership as an exogenous shock to stock ownership. Pretty interesting way to approach it. They find that shocks to a mix of passive and active investors cause big changes in trading behavior and information production, but the shocks do not alter the information content of prices. Wow. So this ultimately suggests that index investing does have effects on investment and information production, but as the theory would predict in the Grossman-Stiglitz framework, the fraction and effort of informed investors adjusts so that the relation between price and fundamental value is unchanged, which is in line with the coin stuff that we just talked about, I think. So no effect ultimately on price efficiency. Okay, so to finish on this topic, the tipping point for indexing depends on the level of competition, like you said earlier, Cameron, among the remaining active investors. If uninformed active investors turn passive, the market actually gets the market gets less efficient, and investors should switch to active, like the Lubosh Pastor paper that we talked about at the beginning. But on the other hand, if it's the misinformed active managers that are turning passive, the market actually gets more efficient, and investors should index and be happy that the market portfolio is converging on the Tangency portfolio. Some evidence suggests that capital flows to informed managers on the mutual fund side from Burke and Van Binsbergen. The coin evidence suggests that on the institutional side, in aggregate, it's both informed and uninformed that are giving up capital to passive. But in either case, and in line with the Grossman-Stiglitz paradox thinking, as assets shift into indexing, the remaining active managers choose to gather information when it's profitable to do so, and the proportion of investors willing to pay an additional cost to uncover new information adjusts such that the returns to active investors remain unchanged, even as index investing increases, which again leaves price efficiency and the effectiveness of index investing as a strategy unchanged. So we're going to do a video on my YouTube channel as well, hopefully in the next couple of weeks. And we're going to do something kind of cool, I think, with that, to pair with that, where we're going to make what do you call it? A companion video on the Rational Reminder channel. So there'll be a video on my channel doing this topic like normal, but then on the Rational Reminder channel, we're going to take the clips of all of the papers that we referenced just now in that video, because again, we have like these perfect outtake clips of each of these people describing the findings of their paper that are relevant to what we just talked about. So we're going to make this companion compilation of those clips. I think it'd be kind of cool. So you have like the CSI video on one hand that you can watch for all the information, and then on the other hand, you have a Rational Reminder. It'll probably be like a 10 or 12 minute compilation of all of the academics referenced in that video describing their relevant findings.
It's really cool because I've been working on the year-end show lately, and there's so much good content that if we start to pull these pieces that explain as you dig into a certain topic, it's a great idea, clearly.
It's happening more and more, though, as when I go and try and write something on a topic or whatever, I realize like I can go and listen to this person instead of reading their paper and suffering through all the formulas and stuff. I can go and listen to them describe their findings.
Yeah.
And it's like with the coin one, like I go back to his paper, the one that I talked about for this, and it's like pretty dense. It's pretty hard to read, but then you go and read the transcript of him describing the paper, and then you flip back to the paper and it all just makes a lot more sense.
Great content. All right, so let's go to our conversation now with our colleague, Jordan Tarasoff, and talk about the Canada Pension Plan and the decision-making that's coming up. All right, so this week we need to cover off a financial planning topic that applies to Canadians who are considering starting their Canada Pension Plan benefit. And there's a really unique situation now where traditional advice may not be the best advice. While this is a very Canadian-specific topic, some of it likely generalizes to other state pension plans. And to dig into this further, we welcome back to the Irrational Reminder our colleague, Jordan Tarasoff. Jordan, great to see you. So Jordan's a certified financial planner and an associate portfolio manager. And recently, congratulations, Jordan, you were awarded the designation of Chartered Financial Analyst.
Yeah, thank you. It was a tough couple of years, but I'm glad to have it behind me.
Excellent. So very briefly, what is the Canada Pension Plan?
So Canada Pension Plan, it's usually called CPP. And today when I'm talking through this, I'm going to have CPP and CPI going back and forth. So I'll try to keep them straight. And so it's a contributory earnings-based social program. What that means is that while you're working between the ages of 18 and 65, If you have a salary, you need to put money into CPP. If you are self-employed, you need to put in both halves of the contribution. If you're working for an employer, they put in half, you put in half. And the purpose of this program is to replace a portion of your income when you're retired. The benefit is indexed, so it goes up each year while you're collecting, and it's taxable as income. So while you're putting money towards it, it's actually deducted off your income. But when you start taking the money out, it gets added to your income, just like a withdrawal from a RSP or a non-social pension plan would be.
Okay, now people don't always take the benefit as soon as they can. What are the benefits of deferring, of taking it later than when it's possible to take it?
Yeah, so there's an option when you actually start taking it. So the normal age is defined as age 65. You can actually take it sooner. You can take it at age 60, but they reduce the benefit you receive by 0.6% per month that you take it earlier. If you take it later, you can actually defer it all the way out to age 70, and you get 0.7% per month for deferring. So if you defer the full 5 years to age 70, you get 42% more for deferring that time, but you give up that 5 years of collecting, right? So rather than having money coming into your pocket, you can invest it, spend it, do whatever. You're waiting 5 years. And so most of the time, that's the only benefits that's talked about. But it isn't just the 0.7% that needs to be included in the decision. There's also a little bit of a difference on how it's indexed before and after you start collecting it. So when you're collecting Canada Pension Plan, it's indexed to CPI, so the Consumer Price Index, which is supposed to be a proxy for how much things retirees are buying actually costs. But while you're contributing and before you start collecting it, it's indexed to wage growth. So how much are wages increasing? And they're not necessarily the same thing. Historically, wage growth has been about 1% higher than CPI. But there's an article that just came out in the Global Mail by Fred Vitisse that's titled, "Thanks to a Rare Event, Deferring CPP until age 70 may no longer be the best option." And so in that article, he shows that because wage growth is typically higher than the cost of goods getting more expensive over time, he has a great example of someone who retired in 2009, but chose to start collecting in 2014. They didn't get 42% more. They actually got 54.9% more. And so the standard advice with financial planners is if you don't need the money, defer it because you get that big 42+% bonus. But this year is a little bit different.
So dive into that. What's going on this year to make the decision a bit different?
Mm-hmm. So this last year, everyone's sort of seen it, that things are getting a lot more expensive, typically faster than wages are growing up. And so the increase in Canada Pension Plan is based on October's year over year CPI numbers. So we don't quite have October's numbers out yet, but if we look at September's numbers, it's expected to be around 6.9%, whereas wage growth, if YMP, the year's maximum pensionable earnings is what we expect, will only be 3.5. So what that means is if you start collecting before 2023, you get close to 7% indexing. If you defer into the next year, you do get that 0.7% bonus each month, but it's only going to be indexed the total benefit at 3.5%.
Right.
So you get almost double the indexing by collecting earlier rather than later.
So you're kind of jumping your pension ahead, notionally?
Yeah, sort of. So you get a higher benefit amount. So it's like you get an extra about 5 months of deferral, even though you don't actually have to defer it the 5 months. You can start collecting it. And so we looked back and we compared wage growth versus inflation, CPI increase. And so wage growth is usually higher. You'd always expect it to be higher, but you can't use the increase in CPI to predict wage growth. So just because it's high this year, things are getting more expensive, doesn't necessarily mean that next year wage growth is going to increase. So this makes a big difference. Yeah. So we looked at the comparison. And so once you factor in the fact that there's two different indexing numbers, if you were to defer to the end of December 2023, you would expect to get an 8.4% bigger benefit, but it's actually only 5% once you factor in the spread between the two different indexing rates. And so with the old numbers, if it's the same, it would take you about 13 years to hit a crossover point where the amount you've received at the higher benefit equals a higher amount than the amount you would have gotten had you collected a year earlier. So the crossover point is about 13 years for you to be better off deferring CPP.
Oh, this is important. So if you start collecting later to get the deferral bonus, so you get a higher benefit amount, but you forego some years of collecting because you're deferring.
Right.
For that to be accretive, for it to be like net beneficial to you, you have to live and collect for at least 13 years under normal circumstances.
Yeah,
Right?
and that's assuming no rate of return. So just straight dollars in. How much have I received? Total it up. It's about 13 years for that crossover point to happen. But once you change that to 5%, the bonus, that gets stretched out to 21 years. So rather than the crossover point being in your mid 80s, it's in your early 90s for you to be better off.
Oh, because you're deferring until 70 and then you have to collect for 20 years, 21 years for the break even to happen.
Yeah. And your benefit's not 8.4% higher, it's only 5% higher.
Right.
Because you got the different indexing amounts. And so this is all just assuming that it's just dollars in, dollars out. But if we assume that you're pulling money from an RSP, so a registered plan to fund the difference while you're not collecting CPP, then if you don't take that money out because you're collecting a benefit, you can sort of assume a rate of return on the funds. And so we did an analysis with a 3% real return on the CPP benefit. And it jumps from, so it started at 13 years under the normal numbers. It was 21 years with the new only 5% spread. If you add in a 3% rate of return, it jumps up to 33 years. So in order for you to be better off deferring for a full year, you would have to live to be 102 under these assumptions.
Wow.
Yeah. So, and even once you get past 102, they don't really diverge very quickly. I looked out 50 years and you're only about 3% better off after 50 years. So if you happen to be one of the longest people around, it's not likely that you'll be better off this way. And we've talked before too about the benefit of having more money when you're younger, healthier, doing more things.
Right. So who like what age group, I guess, is most affected by this thinking?
So this is biggest for people who are 69 now, turning 70 in 2023. Because anyone who's 67, 68, they have multiple years to contend with. The wage growth and CPI might switch around in future years. But this is actually really a big deal for people who turn 70 before May, because they don't get the benefit of a full year of deferral. They only get a couple months. So if you turn 70 in March, say, you're only getting a couple months of that 0.7, but you would have gotten about 3.5% more on the indexing had you just started collecting. Plus you get the 3 months of actually getting paid out. So anyone who's turning 70 before May, you basically get the same benefit, if not more, plus the whole start of the year you get paid out. For clients who are, or for people who are in their age, like 67, 68, 60, that age, it's important to remember that for wage growth, they're not just taking last year's wage growth, they're taking a 5-year average of the last 5 years. And so even if wage growth is really high this next year, so things get more expensive 2022, 2023, all the wages catch up, the indexing is still going to be anchored down by the last 4 years. And so I looked at this, and wage growth would have to be 9.4% higher than CPI next year in order for the math to go back to the way it was before. So for someone who's 68, it's still not really clear that they should keep deferring. The highest spread I ever saw was 5.3 between wage growth and CPI, and that was only for a single year.
Interesting. So we'd have to see a huge spread. And can you talk more about? You said there's not a relationship between CPI and future wage growth. Can you talk more about that?
Yeah. So we did a regression where we tried to use CPI to predict future wage growth to see if there's a relationship there, and there's basically nothing. So there's no correlation between the two. But it is statistically significant that wage growth is about 1% higher than CPI. So if you were going to guess what the spread would be in the future, you would guess 1%. But there's no reason to assume that because CPI is high now, that wage growth will be high in the future, or vice versa. And because of that 5-year average calculation, we know for a fact it's going to be dragged down by the last 4 years, regardless of what it happens to be next year.
Yeah, that's super interesting. So you can't look at currently high CPI and assume that big wage growth that you would need for the break even to go back to what it was is going to happen.
Exactly. So so someone who's 67 can't say, oh, well, I'm going to make it up with higher wage growth in the future. You would expect wage growth to be higher, but you wouldn't expect it to be higher because CPI was higher. It's just going to be whatever it is over the next couple of years.
Like you'd expect a positive spread over CPI on average, but we have no idea what it's actually going to be.
And even if it's like a little bit positive next year, it doesn't matter that much because this last year, there was such a big spread the other way.
Right. Yeah, that's very interesting.
So how are we addressing this with clients?
Yeah, so we're doing a full audit of everyone who could be collecting CPP right now, but is choosing not to. And so that's people between the ages of 65 to 70. So we're looking through to see if it makes sense for them to start collecting, because it's not exactly cut and dry. If you're 69, you should start collecting. We need to factor in things like if someone's still working and they're 69, they might be dropping off really low income years from their calculation in the past. So even though they're getting a smaller deferral benefit, they're making a contribution, which will knock off a zero in the past for calculating their benefit.
You got to explain what that means.
Okay, for sure.
Nothing's cut and dry with CPP. That's one thing we've learned.
Yeah, it's tough. Yeah, so the way, I guess I can dive into how CPP is calculated. It's based on sort of your average earnings over a 40-year period. From the time that you're 18 to 65, they take all your earnings over that time. They drop out the lowest 17%. They drop out years where you're disabled and years where you have kids under the age of 7. So if you have, say, 20 good years and 10 bad years, and you're still working, you're still contributing to CPP, there's a chance that you might be putting money in at a high rate and knocking off one of the bad years, which would increase the amount you collect because your average is higher over the years they're keeping in the calculation. And so, yeah, it's not super clear how you figure these things out. So what we have to do is look at the client situation and see, could they start collecting right now? What's their benefit if they defer? What's their benefit if they collect? And then look at their statement of contributions and see, are we knocking off low income years? And then beyond that, actually, we can look at and see, does it make sense for them to start collecting and still contributing? Because in Canada, you can do something called accruing post-retirement benefits, where you both collect and get bigger benefits in the future. Plus, we need to look at their tax situation too, because if they're working, contributing to CPP, they could collect, but what if they're in the highest tax bracket? Does it make sense to get a higher benefit now, but half goes to taxes versus deferring into the future at a lower tax rate? And so for people who are doing it themselves and are 69, it's worth taking a look. But for us, we have to go through and do a comparison of all these different variables for people.
Yeah, that's wild. So somebody could, if they're earning the yearly maximum pensionable earnings now, that could give them a max contribution year, which knocks off, say they have a low contribution year, a zero contribution year in the past, and that could increase their benefit more than all the other stuff that we're talking about.
Exactly, yeah. So losing a bad year and adding a good year could make up for that spread of CPI being much higher than wage growth this year. And it depends on the person too. Like if they have disability, if they have kids under the age of 7, if they have multiple kids under the age of 7, like it all depends on each person's statement of contributions.
It's incredibly complicated.
Yeah, it's super interesting, super fun to dig into, but yeah, it's pretty complicated.
Yeah, that's crazy though, because it's like there's this really cool planning thing. Oh, but it's not that easy. We can't just say everyone that's
correct
of a certain age should be taking the benefit, or deferring or not deferring or whatever it is. You have to take all that other stuff into account.
Mm-hmm. But the traditional advice, where we kind of ignore that other stuff, they're already retired, they're not working, they're just choosing to defer purely for that 0.7% per month. In that situation, it makes sense to start collecting it sooner. And a lot of clients I've brought this up with have said, well, what does this mean for old age security, which is another benefit in Canada? And for old age security, that's just based on CPI. So just the change in prices while you're collecting and while you're deferring. So this wouldn't change the math around that at all. It's just Canada Pension Plan, because that's based on your employment income and wages while you're working, and then the cost of goods once you start collecting.
Super interesting. That was awesome.
Indeed. Jordan, thanks.
Yeah, thanks for having me.
All right, so instead of a book review like we would often do, because it's Financial Literacy Month, where we're actually going to do 5 book reviews, shorter than usual book reviews, of books that we think are important or useful to financial literacy.
All right, so let's jump in. Number 1, a book by our 2-time guest, Andrew Hallam, who joined us back in episodes 99 and 186. And the book is called Balance: How to Invest and Spend for Happiness, Health, and Wealth. This is actually Andrew's 3rd book, and he sees success through 4 different lenses. Number 1, having enough money. Number 2, maintaining strong relationships. Number 3, maximizing physical and mental health. And number 4, living with a sense of purpose. So obviously 4 very important topics. Very enjoyable book, very easy to read. Andrew weaves in a collection of stories along with research, plus I think some great tips to help you with decision making that will affect your happiness. He also talks a bit about how to decide whether or not you should work with an advisor, and also the kind of portfolio that makes sense for you. And Ben, you actually contributed to this book in the, I don't know if you call it credits or not, but you're in the front part of the book.
Yeah, what's that? The blurb. I wrote a blurb for it.
A blurb. So you wrote, low-cost index funds may be the smartest investment for most people, but they won't tell you how to live a good life. This book will.
I was pretty happy with that.
So I think that's a pretty good bit of support for Andrew's book. Number 2, and this is a book I came across in doing research for this. So the book is called If You Can, How Millennials Can Get Rich Slowly. And this is by Dr. William Bernstein, who is a financial theorist and also a neurologist, and arguably one of the greatest financial writers of our time, and has other very popular books such as The 4 Pillars of Investing, The Intelligent Asset Allocator, and The Investor's Manifesto, which are all excellent. The book, If You Can, was released in 2014, is 48 pages long, and is available for free as a PDF on his website, efficientfrontier.com. So the book starts, would you believe me if I told you there's an investment strategy that a 7-year-old could understand, will take you 15 minutes of work per year, outperform 90% of finance professionals in the long run, and make you a millionaire over time? That's pretty good too. Pretty catchy. Anyways, his site describes the investment savings solutions for millennials as simply to put away 15% of their salaries in low-cost target date funds or a 3-fund index portfolio for 30 to 40 years. Obviously, it sounds easy, but it's no small feat. He then outlines the 5 big hurdles you'll need to overcome: spending too much, having an adequate understanding of what finance is, understanding some financial history, and of course, the biggest enemy, yourself, and the monster enemy, as he puts it, is the industry. So 48 pages, it's more like a booklet, as he calls it, to help people go in the right direction. And I truly think this is a gift from William, so there's no reason that everyone can't go and just grab it, read it. It's an easy read, great little piece.
And he was a podcast guest a while ago.
He sure was. I don't have the number down here, but he certainly was a great guest. Number 3, book by our good friend Bill Schulteis called The Coffee House Investor's Ground Rules. So Bill is a financial advisor in Seattle. And as I mentioned in the podcast when he was on in episode 159, I talked about the influence that Bill's first book and his blog writings had influenced me back as I transitioned from commission to index funds and fee-based back in the mid to late 90s. This book is a 153-page guide to a life of wealth and happiness, and it covers what he calls all the ground rules for success, like saving enough, investing wisely, and having a plan. Very straightforward, very pleasant read, accessible by everyone, and I highly recommend it. Number 4, no surprise to anybody, it's Morgan Housel's book, The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. Morgan was our guest back in episode 128 and was also a special guest for the Reading Challenge in episode 191. He writes a phenomenal blog pretty regularly at the Collaborative Fund. And The Psychology of Money, this book is an absolute must-read for everyone and is one of those books where I think it's worth rereading annually. Morgan's got an incredible gift to weave stories to make interesting points, and he gets these stories, and we talked about this with him when he was on with Tim about his interview with Tim Ferriss, how he gets these stories from just random readings and walking. He does a lot of walking, as you think. So one of the stories was how to illustrate luck and how luck can have a huge impact on your outcome in life. So the example he gives is, Bill Gates was lucky enough to have gone to a school that had computers way back when, and a friend of his and Paul Allen, the 3 of them in high school, were setting out to become computer entrepreneurs. We know how the story goes, but unfortunately their 3rd friend was killed in a very fluke accident in the mountains. So this shows like he was lucky enough to get exposed to computers. His friend was unlucky enough to have this 1 in a million type freak accident. So luck will have a huge impact. And another line I always remember from that book is save like a pessimist, invest like an optimist. Anyways, Morgan doesn't need us to promote his book. He's had wild success with this. The accolades for it are endless. And there's many excellent podcast interviews with Morgan. So check that one out if you haven't already. The last book is from Larry Swedroe. I mean, we could have picked one of many from Larry.
This is a good one though. This has got to be. These are all good books in this list. I'm just flipping through them. If someone were to read one of them and had been not yet exposed to anything about index investing or wow, it's tough because this one's less about like a lot of these other, a lot of the ones that you just went through have a lot on happiness. Hallam's got a big slug of happiness.
Yep.
The Bernstein one, I haven't read that one, but it looks like it's more focused on the investment stuff.
Yep.
Anyway, this Larry book is like to convert someone to this way of thinking about investing and financial planning.
That's a good point.
Is very powerful.
So I dropped Larry a note last week and said, what book should we focus on? He said, yeah, you could mention that one, but he also suggested, investment mistakes even smart people make, and also The Incredible Shrinking Alpha.
Incredible Shrinking Alpha is a very good book too, but Think, Act, and Invest like Warren Buffett is just so accessible.
And that's what I was trying to think of when choosing these books. Accessible, easy read, broad, good starting point.
But it's like I said, if they're like at a bank investing in actively managed funds or whatever, this book is like, read this. Just please read this.
Yeah.
It can be transformational, at least.
Now, the title's a bit misleading, so it's not teaching you really how to invest like Warren Buffett. It's more piggybacking on Warren Buffett saying people should invest in the S&P 500 index.
Yeah, it takes a bunch of stuff, a bunch of famous Buffett quotes, and says how that applies to investing and how anyway.
So there you go. There's 5 books for today. We'll do 5 more.
Is that one still, you can buy that book?
Yep.
Because that was a while ago.
Still available.
Yeah,
they're all available.
It's tough to pick one of these, but that's such like to give to someone as a stocking stuffer or whatever. It's tough to beat that one.
Yeah, I love them all. Love them all. Okay, so ready to see if I can summarize one episode in 60 seconds?
I am ready.
Okay, this is an experiment, so we'll see how this goes. I don't know if Angelica or the team are going to put in an alarm clock or something, but we'll see. So my choice this week was from episode 95 with Scott Rickens, and we both considered it, Ben at the time, a must-listen episode. It's an amazing story of change and transformation, and it's about how after accidentally discovering the FIRE movement, Scott and his wife were inspired to discover their money values. That's the key. They did, and wow, unreal what they did. So they realized they were working hard to pay for things they did not value. So they changed their lives a lot. They sold their luxury cars and their house in Southern California, moved to Oregon, and they aligned their lives with their values. This change comes to life in a phenomenal documentary they made called Playing with Fire. They're happier now. They have a better relationship. They're less stressed. Their financial decision-making is much more purposeful and in line with their values. So I ask everyone out there, have you shared your money values with your loved ones? Is your spending in line with your values? Anyway, Scott and his wife Taylor's journey is a great example of the power of thinking about and sharing your money values.
Seemed like a pretty good 60-second summary.
Anyways,
I guess what's not captured in there is that episode helped us understand the FIRE movement, because we used to be critical of it, I guess, in the early days of our podcast, and lots of people whined about that. I shouldn't have said that, but I said it anyway. People used to whine about it a lot. Ben and Cameron don't understand the FIRE movement. And to be fair, we didn't. And this helped us understand it.
Money values.
Yeah. Aligning your life with your spending with your values.
All right, so this is a perfect segue, Ben, we're going to do a couple of talking sense cards. I'll go first because I know in the past I would ask you to go first. So here's the question. How do you feel when you spend money? And this links directly back to episode 95 with Scott. This has shifted for me. I used to enjoy buying stuff a lot more than I do now. I know what I enjoy doing. So much of what I enjoy doing doesn't cost a whole lot of money. I do enjoy spending on things that are experiences. That I have no regret about whatsoever. Stuff just doesn't do it for me anymore. And it's been interesting because we're doing work to prepare for an upcoming interview to talk about financial relativism. And I this is where you compare spending or incomes or stuff to what other people have. And if you have more than others, that can make you feel happier short term. It doesn't last though. I just don't think of it that way at all anymore. It just doesn't. I'm not aware of doing comparisons like that anymore, which has been an interesting change for me.
Yeah, I don't like spending money. Never feels good. Never.
On some things, it doesn't.
No, I mean, the stuff that I use a lot, I can recognize that it is nice to have it, but at the time of spending the money to get it, never feels good.
That's interesting. So you're more about it feels bad to spend. I just don't get the pleasure out of spending. So I don't feel bad. I just don't do it.
I minimize it as much as possible. I mean, that's one of the toughest things about buying a house is all of the expenses that have come with that.
Out of your control.
Yeah. Well, a lot of it was stuff that we knew we would have to do when we bought the house, but still hurts to actually.
Yeah, but look at your discussion on the trampoline. You could have decked out your living room with $50,000 worth of beautiful furniture, right? If you're in the relativism, perhaps that just I don't think would give you guys a whole lot of pleasure.
No, it would give us stress because our kids would destroy it. But yeah, I'm sure not entertaining any. If somebody values nice things and being fancy, they would not be. I wouldn't invite them to my house.
But your trampoline reflects your values.
Yeah, I guess.
All right, here's the
next one. It was free too. Didn't have to spend a penny on that.
You can go for this next one. What does the phrase "good with money" mean, and can someone become good with money?
Well, maybe it means aligning your objective financial situation with your values, like we were just talking about. I think that's probably a good definition of being good with money. But there's probably other stuff like not having high interest debt, like following money steps that are good. But I guess that it still comes back to if someone really values consumption, then maybe having high interest debt is actually a good thing for that person. So maybe being good with money is different for every person depending on what their values are, which I think comes back to my original answer. Can someone learn to be good with money? Yeah, I think so. I think we see that transformation happening with people who listen to our podcast and tell us, like we talked about in our last episode, all the people who say that listening to us talk to each other and talk to other people has changed their lives for sure. I think if you get information and change habits based on that information, then you can become good with anything, not just money.
Yeah, absolutely, you can become good with money. No doubt about it. I mean, Scott and Taylor did, right? We have endless examples.
Scott and Taylor changed they aligned their financial situation with their values. But there's lots of people who might look at Scott and Taylor's life and say, that looks terrible. I don't want that. I like my fancy car. And that doesn't make them bad with money.
No. All right. That was great. Want to hop to some reviews?
Yep. We got a whole bunch of reviews. We got a really interesting YouTube comment that's kind of aligned with what we were just talking about. Some interesting stuff in the community. So for those 3 people that are just still going to listen to the end here, lots of fun stuff.
All right. Fire away.
Oh, I'm starting?
I can start. I don't care.
Oh, yeah, sure. So Caleb Peters from the U.S. says that the podcast has smart, informed discussions on topics in financial economics and personal finance, and that we line up experts for the show's guests and ask thoughtful questions during interviews, and they appreciate the insights from the book reviews. and that Cameron contextualizes them with themes from previous books. It is good. I like it when you do that too.
All right. Officer 1, BD1 from Australia said, most informative podcast. Thank you so much for doing the podcast. It's so informative and always provides a rational view. I love that you even pick yourselves up when you identify that you're being biased and note it. Best educational podcast out there.
That's good. We're always trying to learn stuff too. VJR3612 from the US said that both of these guys are just amazing. I don't know about that. The amount of detail they pack into an episode is truly great. It is a great learning experience listening to this podcast, and the interviews they do with their guests and the detailed questions they ask is awesome. That's good. We do pride ourselves in the quality of the questions that we send to. I think we've probably talked about this in the podcast before. Like it's often hours, depending on the episode. Like for John Cochran on the fiscal theory of the price level, that was more than I'd have to quantify that in probably weeks or months instead of hours. Yeah. But we just spend a lot of time on questions.
I met a lot of amazing advisors at this conference I mentioned last week, and so many said, "How much time do you guys put into this?" It's significant.
Oh, we talked about this before because I remember it, but it's not a matter of a time commitment. It's like a lifestyle choice. Right? It's true.
It's true. Yeah.
It's not like how much time do you spend on this. It's how did you change your life to adapt to your circumstances?
All right. You want to get a YouTube comment?
Yeah. So this is we don't usually read out YouTube comments because YouTube comments are usually 70% just vitriol, and no, that's not fair. 30% vitriol, 30% scams, and the remainder are actual comments. So we don't usually talk about them, but this one is really nice. So I want to read it. So this is on the investing in your financial literacy video that we did. So they said that their wife and them began investing last March during the peak of the GameStop meme stock craze, and they both went into it completely ignorant, speculated on a few stocks. Before any damage could be done, they found the Roush Reminder podcast and Common Sense Investing YouTube channel. They learned about the benefits of globally diversified index funds and the perils of active speculation. And then they since read many books and listened to podcasts to further their education. But ultimately, us on the podcast here are the greatest influences on their family's financial future, and they're in South Korea. So they're thanking us for that. So I just thought that was kind of cool to see. But it's another example of where somebody can. Well, I guess that's actually interesting, because that's not a matter of aligning their objective financial situation with their subjective values. That was different. That was a case of just not having the information to know what a good financial decision is. Because you could say, well, I'm aligning my values or my financial picture with my values, but if you don't know how to express that could be very messy. So if you end up picking individual meme stocks because you think that's the good way to be putting money away for the future and that aligns with your values, So maybe that maybe there's a more objective way to measure being bad with money. Like, are you buying individual meme stocks? In the Roush Reminder community, there's a small movement that's been started. It's kind of been fun to watch it develop. Called No Net Worth November, where people are committing to not checking their investment accounts for the month of November. This never would have occurred to me because I never check my investment accounts except for when it's like tax time or whatever. And even then, I'm not checking the balances necessarily. But apparently this is a big thing. So a lot of people are concerned that they won't be able to make it for the month without checking their investment accounts. And in some cases, people are making valid arguments like, well, I need to rebalance or I need to invest my contributions or whatever. Anyway, it's just interesting to see this whole discussion about the psychological benefits people think that they would get from not looking at their investment accounts, but the practical difficulties of avoiding looking at them. Practical, in some of the examples I just mentioned, maybe that's more practical, but in a lot of cases, people are just saying that they won't be able to resist the urge to check. So it's interesting to watch that. But if people want to join the No Net Worth November challenge, they can, I don't know, there's no formal way to join it. you can comment in the community post, I guess.
Do you think it's harder to not check in a rising or a falling market? Because we're coming up with the
I've
best Dow
never-
returns since 1976. I saw a headline this morning.
I've never had the urge to check, so I don't know. I'm not the guy to ask. I also wanted to mention that, so we had Scott Cederberg on our podcast last week, and we've had this happen with a few guests, and it's always amazing when it does. But Scott joined the community and was very active in the thread discussing his episode. So that was super cool because people had questions about the data. They had questions about the implications and the insights that you can draw from his findings. And he was right in there giving feedback and answering questions and thanking people for their comments. And it was very cool to see. And I saw that happening, and it's like, where else does that happen? In a place that anybody can join. Like it's not a special club or anything. It's like you sign up for free and you can join these conversations with people like that.
And you guys were thinking we might be up to 10,000 members by Christmas?
Yeah, well, we'll be at 8,000 maybe like in the next couple of weeks. So yeah, it could happen, but by the end of the year, they're at 10,000. I don't know. Well, 2 more months. Yeah, no, it's very possible. I think it's growing at around that pace. Yeah, cool. That's another arbitrary target that we have is 10,000 members in the community. What happens then? Nothing. What do we win? Nothing.
Nothing.
But it would be cool to see. In a couple weeks ago when we talked about our goals survey findings, I gave like multiple disclaimers about how we're not experts and basically have no idea what we're talking about, but maybe this is still interesting research. Justin in the community, who I understand is actually qualified to conduct and review the type of qualitative research that we were doing. They said that when they listened to the episode, they thought that we actually undersold how well the research was carried out and how valid the result is. The primary contributions of the study in their perception was to create a financial goals master list, which fills the gap in the literature calling for the creation of a general master list of this kind, and to describe the methodology of eliciting and analyzing the list. And they said that insofar as those are the goals, the analysis approach was completely appropriate. And they said that it was, in their opinion, extremely well done qualitative research, and that they commended PWL for the effort and sharing the result. And they hope that this is cool. So they hope that future work, this part of the comment isn't cool, but the thing that I'll follow with is, so they hope that future work with this list and research includes researchers with expertise in conducting and disseminating qualitative research. Yes, so I agree. And I'm not going to say who the firm is, and it's not dimensional if that's where people's minds go. But we did share our data with a friendly organization who does have a behavioral science research team. And I don't want to say who it is because I don't know where this is going to go. But hopefully it's something that we can share in the future. They have said that they're putting a few people from their behavioral science research team on this project of looking at the data that we gave them. And they're going to get back to us in the next couple of months, basically, before the end of the year. So maybe nothing happens. Maybe they say the data's garbage. Maybe they come out with some cool insights or suggestions or whatever. Anyway, hopefully it's something that we can talk more about in the future. If not, oh well, but hopefully. And then the other cool thing that I wanted to mention on that is that I sent our summary paper of the goals survey and the master list and all that stuff to Professors Bond, Carlson, and Keeney, who wrote the 2008 and 2010 papers that were basically the basis of that whole exercise. And I heard back from Ralph Keeney, who said that he carefully read the goals survey summary and thinks we did an excellent job and helped many people. So I was like, all right, maybe I didn't give us enough credit for the quality of the work, because that's about the best validation that we could possibly get on that.
Yeah, that's pretty sweet.
Yeah.
Well, you got more feedback on the goals survey from James on LinkedIn. Reached out to me saying, "Hi, Cameron. Massive thank you for the work that you and Ben did in collecting people's financial goals and summarizing it in the master list. I have listened to the RR episode and read through the PWL white paper. It was a hugely beneficial exercise for me and my wife to think about our goals together, then compare it against the list. I know that Ben finds this scary, but you truly are making a huge difference to people's lives.
I'm just gonna have to embrace that at some
Just
point.
embrace it. James, thank you. We appreciate it. Another one I received on LinkedIn. I want to say thank you for the free education and keep up the good work. I work for a wealth management firm in London, England. I joined the finance industry out of university in January 2021 and have been a listener of the podcast for a year. I found the podcast through Ben's YouTube videos. It's been a great source of learning for me. Over the last year, I went back to the first episode. Yes, people do go back to the first episode and listen to them all in my commute each morning. I'm currently completing my financial planning exams as the podcast helped inspire me to pursue a career in financial planning. If you end up in London, it would be great to meet up with you and others that listen to the podcast. And yes, even though there's not a lot of time left, we are having a meetup on November 14th. If you're interested in joining us, and I think, Ben, you'll be joining by FaceTime, so you'll be there live.
I think that's so funny, but yeah, I'll be there.
And you can reach out to Angelica and the team at info@rationalreminder.ca.
Wait, did you say how many people are gonna be there?
I think we're up like 15 to 20 people.
15 to 20 people. And you're meeting at a pub?
Yeah. Any final thoughts?
No, I think that's good. I've gotten a fair amount of feedback on the new format, and it seems to be very positive, and people seem to like the fact that we're just hanging out for the second, whatever it is, like 2/3 of the podcast, we're just kind of hanging out here. So maybe it's the 3 people that only want to listen to the beginning that leave, and everybody else stays. Maybe we had it backwards the whole time.
I don't know.
I don't know either.
Okay. As always, thanks everybody for listening.